All right, well, good afternoon, everybody. Thank you for joining us here on this webinar. My name is Bob Hamilton. I'm an attorney with MidPenn Legal Services in our York office. I'm the manager of special projects here at MidPenn. I handle Social Security disability work as well as income tax issues for the low income taxpayer clinic here at MidPenn. My contact information is up there on the screen. I'll also have it available at the end in case anyone wants to contact us. So today's webinar is, of course, on the 2021 Advanced Child Tax Credit. So what we are going to be discussing today, and hold on as I move through here. Okay. The 2021 Child Tax Credit. So there's a lot of new information that is going to affect a whole lot of people. And I'm going to go through it with you as best I can, albeit very briefly here in the time allotted. So I'm going to talk briefly about the history of the Child Tax Credit, and then the bulk of what we're going to discuss concerns information that you're going to want to need to know as far as advising potential clients and people that you service in your areas. At the end, if we have time, I'll review some common scenarios that we are going to anticipate that may cause problems with certain taxpayers, certain clients, and we'll wrap up then at the end. So to get things started, I like to go through the history of certain things. I was a history major in college, and I just like to know the who, what, when, why of how things came into creation. So just very briefly on the Child Tax Credit, it was created as part of the Taxpayer Relief Act in 1997. It started out as a $500 credit per child under age 17 only. It was non-refundable. I'll talk about what refundable versus non-refundable credits mean in a little bit. But also the initial child tax credit only targeted middle and upper middle income families. So it left out, there was an income cap or a limit that could not go under. So it left out a lot of low income families at first. In 2001, the amount of the credit was doubled to $1,000 per child, and it became partially refundable. And then you can see the two acts there in 2008 and 2009. Coverage was finally expanded to encompass low income families. And then the last major change before this year was the Tax Cuts and Jobs Act of 2017, which again doubled the credit from $1,000 to $2,000 per child under 17. It was made refundable, but again, up until only $1,400 per child. So the passage of the American Rescue Plan in 2021 substantially changed the child tax credit, at least for this year. So I'm going to talk about the major changes that occurred. Number one, more money. So not only was more money made available to children, it also separated different categories of children based on their age. So the amount of the credit has been expanded or increased for $3,600 per child for children aged 0 to 5. And then it's $3,000 per child for those ages 6 to 17. Another new feature here is there is increased eligibility. So there used to be a minimum income requirement for those who were eligible to claim the credit. There is no longer a minimum income requirement for the 2021 child tax credit. So those that usually don't file or earn some amount of income but aren't required to file, they're now eligible to receive that credit. There's also no cap on the total credit amount for filers with multiple children. And the credit amount is fully refundable. So I said I was going to talk about what refundable versus non-refundable means. Just briefly so you can understand it, a refundable credit means that the credit amount, if there's a tax liability and the credit amount exceeds the tax liability, the taxpayer would get the difference between what taxes owed and the credit. So let's say that there's a tax liability of $200 when the person files a tax return, and there's a credit of $1,000. If that credit is refundable, the taxpayer would get a tax refund of $800, $1,000 minus $200. That means that the child tax credit is now fully refundable. So any amount of the credit that exceeds the tax liability, the taxpayer is going to get that difference. A non-refundable credit means that you get credit, but only up to the amount of the tax liability. So in that same scenario where you have $1,000 credit, a $200 amount owed, the credit amount would only be payable up to $200. It would zero out at the tax liability. There would be no additional refund. So just so you understand, if you see the terms refundable and non-refundable, that's what those mean. The other big thing, and this might be the biggest change to the law, is that they're now advanced payments. The child tax credit is going to be bifurcated, split in half, so that half of the amount would be paid out in monthly payments starting this July 15th, continuing through the December 15th. So it's spread out over 6 months. The remaining half of the credit will be paid once the taxpayer files their 2021 tax return in the spring of 2022. The max payments for those monthly payments are, as you can see, $250 a month for children ages 6 to 17, $300 for those ages 0 to 5, and that's per child too. So you can see how that can make a potentially big difference for a lot of the clients that we service. I have a little fact up there that I pulled up from the Tax Policy Center. They're projecting that these advanced payments will reduce child poverty by about 2.5%. So it's a big deal when you think about all the factors that went into putting this into fruition. So the other thing that's new, and it's important to remember, this is just a temporary one-year expansion. So on January 21st, 2022, if nothing else is done in Congress, the credit amount is going to revert back to the prior levels that were established by the 2017 Tax Cuts and Jobs Act. So it'll go back to the $2,000 level per child for those ages 0 to 17. I will mention that President Biden has included a provision in the American Families Plan to extend it through 2025, but of course, there's a lot of other items wrapped up in that American Families Plan, and so we have to get our friends in Congress to agree to that expansion, and as you probably are aware, that is not so easy these days, or I don't know if it ever was, but especially these days. Okay, so I'm going to talk about eligibility criteria. Who is eligible to receive these advance payments and the child tax credit for 2021? So first thing, it has to be a parent, parents or guardians. They need either a valid Social Security number or an individual taxpayer identification number. I'm sure most of you are probably familiar with what a ITIN is, but for those of you that don't, it's issued by the IRS. It's issued to individuals who don't have and aren't eligible to have a Social Security number. So that's a requirement for both parents if it's a two-parent household. The income requirements, as I said before, there's no minimum income requirement anymore. Anyone who has a qualifying child, and I'll talk about what that term means in a little bit, but anyone with a qualifying child is eligible for the credit. Now, the credit does phase out at certain income levels. So you can see the income levels I have listed there. It depends based on what the filing status is, of course. And the amount of the phase out is basically each $1,000 that exceeds the adjusted gross income on the tax return will reduce the total child tax credit by $50. And that's the total credit amount, not the advanced monthly payments that are that are going to that'll start in July. So the total credit amount will be reduced by $50 per $1,000 of AGI over those levels. This is just an example to show you, actually I have two examples here to show you what those amounts mean. This presentation is being recorded, of course. It'll be available on YouTube if you want to review these in more detail. So I'm not going to go over them, but you can just briefly see here just the amount of economic benefit that could potentially happen to single parent homes, homes with multiple children living at home. It's a huge windfall. Okay, another criteria here is that is a residency criteria. So parents or guardians must have their main home in one of the 50 states or DC for more than half the year. So that'd be 183 days at least. It doesn't have to be the same physical location throughout the year. I know we have a lot of clients here at MidPenn that have various housing situations throughout the year that they go in and out of. As long as the children remain in that same location for at least those 6 months, they should be okay. Temporary absences, like for school, military, illness, those kinds of things are generally okay. There are certain rules apply. Don't have time to get into those today. And then I have a note on here too. We do see a fair amount of clients with relatives living in Puerto Rico, or they travel back and forth to Puerto Rico. I just want to note that the advanced payments, so just the advanced portion that is being paid out from July to December, residents of Puerto Rico are not eligible to receive those. However, they still are eligible to receive the full credit when they file their tax returns in 2022. Just something to keep in mind. So the big thing that I'll discuss here as well is you need a qualifying child. It's a term of art. It's defined in the IRS code. And to be a qualifying child, there has to be certain tests that are made. And I have the big four tests are relationship, age, residency, and support. And then I'll talk about social security number, and the child has to also be a dependent of the taxpayer as well. But so long as the child satisfies those criteria, then the taxpayer should be able to claim them and qualify or meet the qualifying child test. So I'm going to go through those each here with the next slide. So the first one is relationship. So obviously it has to be your child, your stepchild, your adopted child who is lawfully placed by an adoption agency, or a grandchild. It can even be a great-grandchild as well. It also encompasses siblings, step-siblings, half-siblings, descendants, so nieces and nephews count, or it can be a foster child. Foster child, of course, it's placed with you by a government agency. The age factor is important here. The child has to be 17 or under on December 31st, 2021. So if the child's birthday is January 1st, 2022, and they're turning 18, they're okay. They can still meet the qualifying child test as far as this 2021 child tax credit. The residency requirement, same rule that applies to parents, applies to children. The child must live in the same household as the parent or parents or guardians for more than half the year. And again, that's just the 50 states in DC. Doesn't have to be consecutive. So children who live with one parent 1 week or 1 month, as long as the total amount of days add up to more than half of that tax year, they meet the residency test for a qualifying child. Again, doesn't have to be in the same physical location the entire year. I have a note at the bottom here. If the residency rule doesn't apply if it's a non-custodial parent, so long as that custodial parent will sign a waiver form. The waiver form is, there's an IRS form for that. It's form 8332. They don't have to file that. They just have to, there has to be a waiver that's similar to that IRS form that grants that non-custodial parent the ability to claim the child. So just wanted to point that out as well. The other test for qualifying child here is the support test. I'll be honest, I have not, in my years of practicing with the tax clinic here, I have not encountered this situation. That's not to say it doesn't happen, but the child cannot provide more than 1/2 of his or her own support during the year. I have an example. So if you have a taxpayer who provides his 16-year-old son with $4,000 in support, but the son has a part-time job and earns $6,000, so the total support is $10,000. The son's providing more than 1/2 of his own support. He would not meet the qualifying child test, and the taxpayer would not be permitted to claim his son as a qualifying child or a dependent in that case. A couple other things here. Child has to have a valid Social Security number. So no ITIN in these cases, has to have a Social Security number. And then the child has to also be claimed as a dependent on the return. That's generally not an issue. It used to be an issue, but if you're going to qualify for the child tax credit, that qualifying child has to also be listed as your dependent on the first page of the tax return. Some other things to know here that are important. There are the effect that the advance payment and the child tax credit has on government benefits. It doesn't count as income for programs like SNAP, temporary assistance to needy families, or Medicaid, which is great. The other good thing is that if a taxpayer saves the child tax credit in a bank account or elsewhere, it doesn't count towards the asset limits in those programs for 12 months. And finally, it's not considered taxable income either. So those are all good things. I want to talk about offsets really quickly. So an offset is where a typical scenario that we see is if a tax refund is intercepted by either a government agency or another debt collector and applied to an existing tax debt. The good news here with offsets, as far as the advanced child tax credit payments are concerned, so the monthly payments, those can't be intercepted and applied to past due child support, back federal and state tax debts, or any other federal or state tax debts. So if someone has student loan debt, federal student loan debts that's in collections, if they get the advanced payments, if they opt for the advanced child tax credit payments, those payments can't be intercepted to go to those loan debts. Now, I'll just skip to the bottom here. With the remaining portion of the child tax credit, when the taxpayer files the 2021 tax return, if any amount of the child tax credit is refunded, that amount can be intercepted and applies to those debts. But as far as the advance payments are concerned, that is not the case. Another thing to point out here too is that the advance payments are not protected from garnishment by creditors and debt collectors. However, it does depend on the state. The IRS did leave it up to state and local laws. I have not done a deep dive into if any states are preventing these offsets, but that's something to keep in mind moving forward as the advance payments start to roll out. You might be asking, how is the IRS going to know what payment amount to send to the taxpayer and where to send it and what method? So the IRS is, for the majority of people, they're going to use an automatic system where they'll just review the most recent information that they have in their system. Typically, it's going to be the 2020 tax return that was just recently due, or if that hasn't been processed yet, and I know that we have a lot of clients whose 2020 returns still haven't been processed, they're going to use the 2019 tax returns, whichever one is the most recent information on file. That also includes anyone who signed up for the stimulus payments last year using the IRS non-filer portals. If that information was entered into the IRS system and it remains current, then they don't need to take action either. The key there is if it remains current. So if information is changed, I'll talk about, the next slide actually is going to talk about what they can do to update their information. But if everything's remained the same and they just use the non-filer portal last year, they don't have to take any action. Now, if they didn't file a return in 2020 or 2019, and they didn't use the non-filer portal, there is a portal available on the IRS website called the non-filer sign-up tool. And that brings me into the next slide, how to access the advance payments. So there's supposed to be 2 IRS portals available. One of them is currently available. The other one is only partially available. So the one that is currently available is the non-filer portal that I just talked about. There's the website there at irs.gov. Again, you're going to use it if you did not file a 2020 return or didn't have to file a 2020 return. And also if you haven't filed a 2019 return. And then you can see there, or if you filed a 2019, but you didn't claim all of your qualifying children for 2021 on the 2019 return. It does get a little complicated. I think that there are, the IRS was supposed to send out letters. Most people should have gotten them already earlier this month, stating terms of whether they're eligible for the credit. So if people didn't get those letters, they have questions, you can log in and check your information on the IRS website. If you're not sure, or if the client's not sure, try using the non-filer portal and see what information is up and running there. The second portal that's available is the Child Tax Credit Update portal, or what the IRS calls CTC Up. So right now, this portal is only available to anyone who wants to opt out of the advanced payments. Other functions are not going to be available until later this summer or fall. I'll talk about those on the next slide. But I wanted to briefly talk about why someone would want to opt out. There's no penalty for doing so. There's no tax break for doing so. But you might question, well, if the government's giving out free money per month, why would anyone opt out of that? Well, there's a few reasons. One is if the taxpayer typically owes taxes come tax time, that full amount would then, the full amount of the refund would then, if they're due a refund, would then go to satisfy the tax debts. Also for those individuals who maybe switched to a higher paying job in 2021, remember that the IRS is using historical data either from 2019 or 2020. So if income has increased in the household in 2021, it's possible that the IRS might be overpaying the taxpayer the advance credit. So if folks have questions about that or unsure, it might be advisable for them to opt out. The other reason, of course, is if there's large expenses that taxpayers have in the spring, like a tuition payment. I talked to someone recently who wanted to defer until the spring and opt out because they use the tax refund to pay for their vacation in the spring. They want to pay it all at once. They don't trust themselves to save that money monthly as they receive it. So it's perfectly, you're allowed to do that. The IRS is allowing you to do that at this time using the UP portal. These are some functions that are supposed to be available later in the summer with the UP portal. Importantly, updating bank account information. They said late June. Clock's ticking on that. It's June 29th. I haven't seen anything released today, but should be able to update bank account info so that the IRS is sending payments to the correct account. Mailing address, updates to change in your marital status, change in income, change in the number of children. Those are all expected for later this summer. We were hoping that it'd be sooner, but unfortunately that's what we're dealing with. There's repayment protection as well. I talked about, if a taxpayer does have an increase in income for 2021 versus the other years, the IRS could be potentially paying that person more money than they should be. If that's the case, they may have to repay those advance payments. So it's really tricky. It's something that folks should consult with their tax preparer or accountant about. But for a lot of the low income folks out there, there is repayment protection. So you can see the amounts listed there. There's full protection for those filers so long as their adjusted gross income doesn't exceed those limits. If it does exceed those limits, there is partial repayment protection, then it caps out at the limits below. There's $0 repayment protection for those filers. All right, so I'll talk about potential problems here. One thing, of course, is non-filers, people who don't typically file, trying to identify, locate, and help those individuals who really could need this additional income, or not income, but this additional credit, making sure that they get that financial assistance. The other thing, of course, is making sure they have access to the internet. There's problems, of course, when you register for one of the portals. You have to make sure that your identity, the information the IRS has on file, matches what information you're providing them through the portal. So we've had scenarios where clients can't verify past addresses or past income. They haven't filed for a number of years, and the IRS is asking about information that is 7 years old and they don't remember. So those situations are tricky. So we do see issues there. Another issue, of course, is people who have what we call flexible family situations. So if there's shared custody agreements, parents who alternate years claiming the child tax credit, you know, the IRS is going to make the payments to whichever parent claimed the child on either the 2020 return or the 2019. It's the most recent data. So if you have a situation like that, it'll be important for those people to update the information on that portal that isn't going to be available till later in the summer. So that's something to keep in mind as well. Also want to talk about, of course, there's adversarial family situations. So someone who is claiming children who doesn't have a right to, and you have the custodial parent or the person who rightfully should be able to claim the children being shut out of that money. We've filed identity theft actions against, or we filed what are called identity theft affidavits with the IRS to flag those issues when we spot them. And I have on here, it's important that any outstanding identity theft issue, if it's unresolved by the time the advance payments go out, that taxpayer is not going to get those advance payments until that issue has been fully resolved. However, just keep in mind for those folks that don't receive the payment, they're still eligible to claim it in 2021 in 2022 for 2021 when they file that 21 tax return. So they're still eligible. Hopefully the identity theft issue would be resolved by the time that they do file that return. Last thing I'll talk about just real quickly, always beware of tax scams. It's important to remember the IRS is not going to initiate contact by email, text message, social media to request any information. Most times, I would say 99.9 times out of 10, they're going to send you a letter. There are scenarios where they do make contact in person, but for the majority of our clients, it's going to be contact via a letter. So don't respond to any of those messages through those mediums. The IRS is also never going to ask someone to pay by cash, or gift card, credit card, store card. I've seen in the past situations where the scammer will request someone go to Walmart and get a store Walmart card, and they'll be promised to load money onto that card, and it turns out to be a scam. So just some things to watch out for. With these new laws, there are always going to be new fraudsters and new tricks up their sleeves to try to con people out of this money. So it's something we're all monitoring, and it's something that you should monitor as well. So that was just a brief overview. Of course, there's a lot more to talk about. I would say that if you encounter clients who have issues with either the advance payments or tertiary issues around the advance payments, you can feel free to have them contact our intake line that's listed at the top there, 844-MPLS-TAX. That's for our low-income taxpayer clinic. I would say if any of you have any questions and you want to reach out to me regarding any of the information presented here today, there's my contact information. Feel free to call me or email me. I'm happy to chat, go over any issue that you might have. And I thank you all for your attendance here, and I hope that you learn more about the child tax credit.
Bob, we have a question in the chat.
Sure.
Do you have to pay this child tax credit back?
So for, I would say the majority of the low-income population, remember there's that, there is that waiver for the repayment. Let me try to go back to the one slide. The repayment protection. So generally, no, so long as their income does not fall above certain thresholds. So let's say you have someone who is a head of household, so they have children at home, but it's a single parent household. And in 2020, their return says they earn $40,000 a year. So the IRS starts making payments to them, starts making the advance payments based off of that $40,000 of reported income. Well, this year they got a raise or they got a new job and they're earning $49,000 or $50,000. So technically then they're earning more than what was reported and what the IRS based their payment off of. They will be waived, so they won't have to repay anything back because they still fall below that $50,000 threshold. If they're earning up to $100,000, then yes, and if it's above 50, there's a phase out provision as well. I don't have those charts in front of me, but they could potentially owe a certain amount of that money back. And if it's $100,000 or above that particular person is earning, there's no repayment protection, so they'd have to pay it all back. So it is very important to monitor that. As I said, I don't think the majority of the clients we service would qualify for the repayment protection, but I definitely envision scenarios where, especially 2020, there was a lot of people unemployed. Now they're back to work. So if the household income reported in 2021 is much higher, it could bump them up a tax bracket, and they could be faced with a significant tax bill or just something that they wouldn't be expecting in a normal year. So short answer is perhaps. It really just depends on the income that they're earning for 2021.
Okay, we have another question.
Sure.
A mother who only receives SSI for mental health issue, has one child, has filed 2020 tax for the stimulus payments. Would she still be eligible for the tax credit even though she does not work?
Yes. So there is no income threshold. So this applies to anyone that does not have earned income or income that has to be reported. Yes, she would still be eligible so long as the child meets the criteria for a qualifying child. So age, residency, support, and relationship, and has a social security number and is a dependent. They would meet, yes, then they are eligible. Any other questions there?
Okay, I'm not seeing any other questions.
Okay. Well, again,
wait, hold on. We have a question.
Okay.
It won't affect her SSI check.
So correct. It's not supposed to be counted as income or as an asset for most government benefits. So I'm pretty sure SSI falls within that criteria. I'd have to look it up and double check, but I'm fairly certain that that would be the case. Yes.
Okay, that looks like that's it.
Okay. Well, again, thank you all. I hope you enjoy the rest of your day, and feel free to reach out to me if you have any other additional questions or want to talk about any other tax issue as well. I'm happy to help as I can. So.
Okay, the webinar is now concluded. Have a great day.